Imagine you're a company and you need money. You could go to a bank, sure, but banks sometimes act like that auntie who says, can, but must pay back first. So instead, companies issue corporate bonds. Corporate bonds are basically the company saying to investor, hey, lend us money and we'll pay you interest regularly. Then on a set that, we'll return the original amount you gave. Simple. Investor gets steady income and the company gets fund to grow. Why do companies prefer bonds? Because they can raise bigger amounts from more people for longer periods. They can also customize the terms to suit their needs, and the best part, they don't lose ownership or control like when selling shares. 3 keywords: principal, the amount borrowed; coupon rate, the interest paid; and maturity, the payback date. So in short, corporate bonds are like a win-win handshake between companies and investors. Money flows, project grows, and nobody has to beg a bank.
Assalamualaikum. My name is Nur Hidayatul Hikmah binti Malin. My matrix number is BG221-10156. Today I would like to talk about the future and underlying purpose of corporate debt. The fundamental structure of corporate debt is defined by 3 key features category that manage risk and costs. Security status and repayment priority establish protection, while embedded option introduce flexibility. For security, a company issues secure bond to lower its cost of borrowing by offering collateral, where unsecured bond maximize asset flexibility but require a higher yield. Similarly, senior debt creates the safest tier of financing. These bondholders are the first in line for repayment after secure creditor if the company liquidates. This allows the company to issue subordinate debt to act as a crucial capital buffer, which is a layer of capital designed to absorb losses before the senior debt and deposit are affected, as well as can absorb risk at a higher cost. Finally, the company can use embedded option to reduce initial cash payment. A callable bond offers the issuer refinancing flexibility if rate falls. A callable bond gives the company the right to buy back the bond from the investor before its maturity date. Conversely, a convertible bond reduces the required coupon rate by offering the investor potential equity upside.
My name is Amira Kairina binti Ismail. My matrix number is PG221-10372. Now I will explain the basic concept of risk and return for corporate borrowing. In general, the risk of borrowing refers to the chance that the company might not be able to pay back the investor. This is called credit risk. There are also other types of risk. For example, interest rate risk, which happen when bonds prices drop as market interest rate increase. And then there is a liquidity risk, which means some bonds may be difficult to sell quickly at a fair price. Because investors tax on this risk, they expect a return, which come mainly from the coupon interest payment and the repayment of the bond's face value at maturity. In short, the higher the risk, the higher the return investors expect. And that is why corporate bonds usually offer higher yield than safer bonds like the government bonds. For example, Petronas corporate bonds offer a stable but a higher return compared to the government bonds because they carry slightly more risk. So, overall, risk and return always come together. Investor earn more only when they are willing to take the
Now,
risk.
I will be sharing a brief overview of Cajamas Berhad, Malaysia's National Mortgage Corporation, an example our group had choose. In 2022, Cajamas successfully issued RM200 million worth of bonds with a coupon rate of 4.18% per annum, set to mature on 26 July 2027. The main purpose of this is because this issuance was to finance the purchase of housing loans from financial institutions and to support liquidity in the domestic mortgage market. In simple terms, this means Cajamas helps banks and lenders free up their funds so they can continue giving out more housing loans to Malaysians. Through such initiatives, Cajamas plays a vital role in strengthening Malaysia's financial system, promoting home ownership and ensuring stability in the housing finance market. In summary, this RM200 million bond issuance reflects Cajama's continued commitment to building a more stable, efficient, and accessible housing finance ecosystem for the nation. Thank you.
Next, I will explain a simple bond quote using a real example from Cagamas Berhad, which is Malaysia's National Mortgage Corporation. The bond I selected is called Cagamas MTN 4.180% 26/7/2027, as shown in the screenshot from BIX Malaysia. This bond offers a coupon rate of 4.18% per annum, meaning investors will receive 4.18% interest every year based on the bond's nominal value. It will mature on 26 July 2027, and the issue will repay the principal to investors at that time. The bond is rated AAA by MARC, which indicates very low credit risk and strong repayment ability. According to the latest data on 12 November 2025, the last traded yield is 3.394% and the last traded price is RM101.28, slightly above par value. This shows that investors have high confidence in Cagamas Berhad as the price is trading above RM100. Overall, this bond provides stable and secure income, making it suitable for conservative investors who prefer low-risk fixed-income securities. In summary, the Cagamas MTN 4.180% 2027 bond reflects a strong, well-rated, and stable corporate bond in the Malaysian market. That's all for me. Thank you.
Hello everyone, my name is Nurul binti Zari and I will be explaining the comparison between corporate bonds and sukuk. Corporate bonds are debt instruments issued by companies to raise funds. Investors lend money to the company and receive interest payments, also known as coupons. This creates a debtor-creditor relationship where the company is obligated to repay the borrowed amount with interest. In contrast, sukuk are asset-based Islamic certificates that follow Sharia principles. Instead of earning interest, investors gain returns through profit sharing or rental income from underlying assets. Sukuk holders have ownership or partnership rights in those assets, which makes it compliant with Islamic finance rules. In terms of backing, corporate bonds rely on the company with creditworthiness, while sukuk are backed by tangible assets or projects. For example, Tenaga Nasional Berhad issues corporate bonds, while Petronas issues sukuk in the global market. In summary, the key difference is that corporate bonds are conventional and interest-based, whereas sukuk are Islamic and asset-based. That's all from me. Thank you.